Thank you, Steve, for taking the time to sit down with me today just to talk about navigating through this choppy market, um, what's going on, the challenges, and with the mortgage market, it's one of those things where there's some cyclicality to it. So there's always been peaks and valleys and
Mm-hmm.
waves. Um, everything from interest rates affecting how much volume is going through the industry to volatility in whether there's homes available for
Mm-hmm.
sale in the inventory. But we're starting to see some new, what I'm going to call white caps, coming into the industry. This rapid increase in rates has contributed to stress in the banking sector, and this has had it's had an impact on available funding
Mm-hmm.
for mortgage companies. And just kind of wanting to hear from you, how are you seeing some of that right now?
I think your analogy of waves and whitecaps is really a good analogy because in the mortgage industry, it's really been a lot of peaks and valleys, or so the analogy of a wave is really a good way to put this. So um, in the last cycle here, though, we've had higher highs, right, with rates being super low,
Yeah.
right, a big boom in refinances, right, and now we're in a trough. It's a lower low than we've probably ever had before, with rapid increase in the interest rates, right, which has just crushed the refinance market, right. So refinances have pretty much gone away, right, unless there's a family change where there's a need for immediate cash out of your home.
Right.
They're all but gone. But it's also the rising interest rates really affected the purchase market too, and not in a good way.
Yeah, absolutely. And going back to a little bit of what's gone on with the banking crisis, I think you're seeing banks are changing maybe some of the business lines that they're
Mhm.
in, whether that be loans they may look to buy. There might be a tightening of that market.
Mm-hmm.
I don't know if you've seen any of that.
In the jumbo market, right? So for the banks, there's a cost to fund loans, right? And there's a few different things that have really affected banks' appetite for the jumbo market, right? One, it's just more expensive to access funds to make that lending, right?
Right.
And so it's hard for a bank who wants to be liquid and find opportunities in the market to invest into a mortgage that's a 30-year security, right?
Mhm.
So that locks you in for 30 years. It can be a great investment.
Right.
It's a steady return.
Exactly.
But as the market changes and investors want to move their money around and to chase after the new markets, you can really get stuck into a situation as a bank that you don't want to be in. So banks have to really think hard about what is their real business and what do they want to be investing in. And for some of the banks, the jumbo mortgage market is something that they have, backed away from.
Yep. And I think we're seeing something very similar in the warehouse market as well too, is that banks are making that decision, where do they want to allocate their
Mhm.
capital? And with warehouse lending, you want it, I want it, we want those loans turning off in 15
Right.
days. And so it's something that they can unwind out of pretty quickly. So we are seeing a number of players that have exited the market, largely due to the fact that they are choosing to put their capital somewhere else.
Right. You
Yeah.
can, like you said, you wind it down quickly. You can bring your capital back into the bank for reinvestment somewhere else. So it's hard to do with a 30-year mortgage,
Yeah,
right?
you're right. You're
So-
right. Well, in times like this, it seems like it's really important to have good and stable partners. For IMBs, it's your warehouse bank, it's your secondary market of investors, like you've alluded to. And for the warehouse bank, we want strong, stable, steady
Mhm.
customers like Summit Mortgage. What type of challenges are you seeing? I mean, the market overall is challenging, but maybe just talk a little bit specifically about some of the challenges you're seeing.
Yeah. Well, you're exactly right. We do have two critical partners as an independent mortgage banker that we really rely on. And it's the two you just mentioned, which is our warehouse banks and the secondary markets, right? Those two groups are what allows us to provide the funding for a loan and then hold on to that loan long enough for the secondary department or secondary markets to purchase that loan, freeing up liquidity so that we can lend to the next borrower, right?
Yep.
without a real healthy relationship, strong relationship there, you know, we could run out of funds to lend to the next borrower that comes along. So it's just such an important relationship that we need to keep fostering.
So we just talked about the fact of it is so important to have those good partnerships and those good relationships, and especially during this time where we're seeing some additional challenges that are in the marketplace. You know, I think maybe you could just talk a little bit about some of those challenges that you're seeing.
Yeah. So there's a lot more than just interest rates that drive the marketplace, right?
Mm-hmm.
So we already talked about, you know, a lack of inventory. So one of the big challenges we have has really been the supply chain disruption that have happened over the last couple of years with, you know, the pandemic and the costs of new construction and, you know, some new housing coming onto the marketplace.
Mm-hmm.
So it's really helped to constrain the availability of housing by, you know, hurting the construction market, the long-term financing by builders for, you know, new construction, right?
Mm-hmm.
So that's one of the things that's holding us back. I'm sure, you know, as in the banking, right, industry, you're always looking for fundings for new construction,
Mm-hmm.
and so that funding for new construction comes and goes just the same way as
Yes.
funding for housing, right?
That's right.
So it's been a real challenge to get that new construction back up and running again. And unfortunately, I feel like we just started
Getting there.
as the pandemic ended. And now with the raising interest rate, that's another cost bearer for contractors to start new housing, right?
Absolutely.
Yep, the cost to hold the land, you know, the cost for waiting for permits and that kind of stuff, so.
Exactly. And, you know, from the vast amount of volume that was created
Mhm.
during the pandemic, it seems kind of unfair that now we get a couple years down the road and, some of those secondary market buyers are coming back and saying, ooh, this loan didn't come out just exactly right.
Yeah, that's it's another challenge out there for sure. You know, what happens is that the industry boomed so quickly,
Yeah.
right, that we all scrambled to serve the customer.
Mm-hmm.
And in doing so, volume increased so rapidly that we had to hire new employees. And it takes a long time to get new employees up to speed on underwriting standards, quality control, you know, all those kind of things that you deal with as a company. And so as we moved to very quickly into a boom cycle, you know, there's the old triangle of time, quality, and cost, right?
Mm-hmm.
So we want short turnaround times for our customers to provide customer service, but we got to keep quality high and do it at a reasonable cost for the consumer, right?
Right.
But unfortunately what happened was, in a lot of situations, is quality was hurt.
Mm-hmm.
So Fannie and Freddie have, as you know, a 3-year reps and warrants, right? Where they give us reps and warrants on some minor flaws in the file. Well, we're coming up on that 3-year time frame. So Fannie and Freddie, they've been looking at loan files that they've purchased in the last 3 years during the biggest boom times that we've had. And yeah, they're looking for lenders to rep and warrant, you know, the quality of the work that they've done. And in some cases, there's been some quality issues. So
Sure.
buybacks are a real challenge in the industry right now.
And exacerbated by the fact that a lot of those mortgages were done when the prevailing rate was 3%.
Exactly.
And it certainly isn't anywhere near 3% now today.
Right. So, you know, that's one of the risks for us is if we have to buy a loan back from, say, a Fannie or Freddie, you know, with interest rates being up into the 7%, those loans are at 3%, well, there's not a real scratch and dent market for that. So you're taking a deep discount to resell that loan to somebody else. So it's a real challenge and could be you know, something that could really harm you.
Yeah.
So as a warehouse lender, I appreciate that you guys are always looking out and working with, you know, quality lenders that, you know, didn't.
It is important. It goes back to that. It's the relationship that we have with strong, stable companies who really adhere to a strong manufacturing process.
Absolutely. That's so important.
Absolutely.
So we've been challenged on some buybacks also, but a lot of them we've been able to provide the documentation showing why we made the credit decisions that we did, and they've accepted those those
Knock on wood,
rebuttals.
right?
Right. But you asked about a few other challenges out there, so I'll talk about a couple other ones. There's been a lot of regulatory changes here in the last several years too. So, and specifically around compliance with consumer privacy laws, right?
Yeah.
And so, although volume has dropped, our compliance department and our the quality of what we're doing as a lender, there's been more focus on that to protect consumer privacy, cybersecurity right now, especially with what's going on in the world environment.
Yes.
It's left up to us to secure the data of our people, or of our borrowers, right? And then really, you guys feel it as a banking partner, right? As the liquidity requirements that are new regulations that have come out. And that makes it even more challenging for a bank to invest into mortgages, because if you have to hold more cash on hand
That's right.
to hold the MSR values, the mortgage servicing values, then again, you have to decide on, can that cash be better used somewhere else?
A lot in the market right now that the companies that are retaining MSRs and retaining servicing are performing better than those that don't. But with it also comes some risks.
Yes. So when you talk about performing better than those that don't, it's every time the interest rate goes up, right? The mortgage servicing value, the value of that asset is based on how long you can predict you can hold on to that servicing and collect a fee. So as interest rates go up, if you have a lot of lower interest rate loans in your portfolio, that value goes up, right? So it's really a book value. Now the challenge comes in to where if you ever have to sell that servicing, is there really a market to purchase that servicing at what you have on your books, right? And so there's two things that really affect that. And when you're evaluating somebody like Summit Mortgage, right, an independent mortgage banker, there's a real deep discount if you have to rely on that mortgage servicing to bring in cash for the company. Not only do you have to find a buyer in the marketplace, right, that's going to buy it at what you think it's worth today, but then once you sell it, it's a cash event. And when you have a cash event, it now becomes taxable.
Tax event.
Right.
There's been a lot of press recently about homeowners insurance. From the rise in annual premiums to insurance companies leaving certain states altogether. What impact has that had on Summit Mortgage and just mortgage lenders in general?
There's been a lot of conversation of will people be able to continue to get insurance? And so, somebody will always step in and insure. The real question is, at what cost, right? So really, you're affecting people's ability to purchase a home. Again, we all have limited resources, so that's part of your debt to income calculation, is how much are you paying in insurance. So if your insurance cost goes through the roof, how can you afford a home?
Wow, we have covered quite a few challenges that are out there in the industry, and not to bring just all doom and gloom, let's talk about some positives now. And how do you, as an IMB, navigate through these choppy waters?
Well, one of the biggest things is really to be honest with yourself about where you're at as a company and what your real goals and focus are. So, a lot of these next things we're going to talk about, we're kind of stealing from Garrett McCauley, right?
Oh,
who's brings this out every year as a
Absolutely.
talking points. But one of the things we talk about is always relying on the relationships you have with your partners, which is what we're here talking about today. Is right, having partners that you can rely on during the tough times, during the booming times, during the bust. Those that can have a long-term vision with you, right? and is willing to work with you through navigate through all the choppy waters. So, that's one of the big things is the stability that you have in your relationships. We have to always look at what we're doing as a company too. And so you're relying on us to, keep reevaluating our model and what are we doing and does it continue to make sense?
Yeah.
Stuff like, are we securitizing our own loans? Are we selling to the secondary markets, on a mandatory or best efforts basis, right?
Mm-hmm.
Do we continue to employ an underwriting department, or do we go non-delegated with some of the secondary outlets, secondary market outlets, right? So those kind of business decisions and managing cost and really managing what the values of the company are and how we serve clients to drive more business,
Exactly.
is really one of the big differentiators on whether you can survive through the tough times or not. So. And then, one of the things that we've done over time is, looking at ways to continually be more efficient at what you're doing. So I think we're going to get into this conversation a little bit.
Yeah, a little bit.
In a few minutes, but really always looking at, we have new technology coming out all the time. I was just telling Justin over here not long ago how I'm really starting to figure out how to use ChatGPT as a resource to communicate better with the team and that, right?
Yeah.
So there's always new things coming out, and how are you looking at technology to improve your processes and what you're doing, right?
Stay more efficient, stay nimble.
Yeah, stay more efficient, nimble, always be looking ahead. In times like this where you may have reduced staff and that, you've always got to be looking ahead as to, hey, volume will come back. What are you going to do when that comes back? Are you just going to hire a bunch of people again and go through the same growing pains you just went through?
How many times in a row do we keep doing
Right.
that?
Or how can we use technology and other systems to become more efficient so we don't have as choppy of water during the next cycles, right? So it's a big part of what we're thinking about. So those are really, focusing on things we can control there. And one of the things we're trying to make sure we control is make sure that you stop losing money at some point. Or at least know how much you are investing back into the company, right? As you may not be profitable today, but how long can you maintain what you're doing? What kind of investment, right, for the future? And those are all just important things we're going through right now as a company, and really employing our team and our partners.
Headwinds that we have today may change.
Yep.
They may abate. And so we have to start thinking about when that does change, what does it look like? So if you can reduce your overhead and get it to the point where you're not losing a lot of money, just the slightest incremental bump in activity and volume can really flow to the bottom line really quickly. But with that also comes some risks. I think you kind of touched on that a little bit, is have you cut so much into the bone that you're not able to meet that? Right.
So, you want to continue to provide, great customer service. Our business is based on referrals, right? Referrals from business partners, different real estate partners, all different areas. And so as the market picks back up, you have to meet the expectations of those partners so that we're all serving the customer, to meet their expectations and get that next referral, right? That can be challenging.
Yeah.
So as the market picks up, do we have the right people here to serve the client? We just talked about quality control in the past may have suffered, in the last boom cycle.
Sure.
How do we come back and serve that volume of customer again with the people we have? Or how do we ramp up quickly, right? That's always a challenge. So yeah, it's a good thing to be thinking about is how do we get to the next cycle? How do we make it through this one, but be prepared? What are the steps? And that's planning, right?
Yeah,
That's thinking ahead.
absolutely.
What does your volume look like when it doubles?
Exactly. And can you handle
Mhm.
it? Are there opportunities that are out there for you as an independent mortgage banker?
Yep. There are, other companies. It's not like we're alone in this conversation, right? So there are other companies out there that are struggling. There are other people that, may have to leave this industry. Other companies that may have to leave this industry to serve the number of borrowers we have. As an industry, we are overstaffed for the number of clients we have today, right? So there are opportunities for us to pick up good loan originators, good branches.
Mm-hmm.
The challenging we've had with that is that, they come with the habits of the boom time yet, right? And we may have to help them, right size their branch, right? It's really difficult. We all have to remember that we're in the people business, so it's really difficult to let employees go. Or think about, what do you really need?
Yeah.
And that's the conversation we're having with anybody we bring on board today, because we can't take on somebody else's problems,
Mhm.
right? So if a branch is losing money at another company, why would they come here and make money here,
Right.
right?
What changes?
What
Yeah.
changes, right? So we have to talk them through what needs to change to be successful in the future. So a lot of the recruiting is not just finding somebody that's...
You're doing a little counseling too.
You are, absolutely are. We're doing a lot of counseling. So it's been a different style of recruiting, a different style of conversation. And it's kind of been fun in a way, because a lot of the branch managers and good loan officers have never had to deal with that in the past, or have never had somebody from a higher level in a C-suite explain to them how P&Ls work, how what you're doing in a branch actually affects your price to the customer, right? They've never walked them through the steps of how to get there.
We talked a little bit ago about the importance of leaning into your relationships, and we've been really fortunate to
Mhm.
have a long relationship with Summit Mortgage. Summit is Fidelity Bank, now Scale Bank's longest standing warehouse client.
Mhm. We've been through a lot together, haven't we?
We've been through a lot together, and I believe that Fidelity Bank, Scale Bank, is Summit's longest warehouse partner.
Yeah,
So we have been through a lot
that
together.
we have.
Maybe even just going back and talking about some of the things that we've gone through together goes back to what's gone on here at Summit.
Sure. It's been kind of fun. It's a neat journey, right? And I've only been here for half of the journey. So I've been here, 13 years now. So, and your initial relationship with my in-laws, Bob and Diana. So I took ownership of the company back in 2019. So that was a big change that,
Big
you
change.
stuck with Summit, right?
Absolutely.
So it's that's neat. So for me to come into the industry, learn the industry through a bunch of different paths on how to get here, and then for you guys to stick with us as Steve comes in and right
Yeah.
kind of changes what we're doing as a company. It's been a fun journey from that standpoint, from an ownership change standpoint, right? But on my journey, there's been a lot of things that Summit has grown into too,
Absolutely.
right? So one of the big things was we went from being a best effort shop, selling to the secondary
Mhm.
department in a best effort way, to being a mandatory shop where we're doing our own hedging and holding on to loans for a time period that they're not committed,
Exactly.
right, to a secondary investor, and then selling them, at a little margin there,
Yep.
right,
Yep.
at the mandatory commitment levels.
Probably our most recent change that we've gone through together
Mhm.
is Fidelity Bank, as of September 19th, became Scale Bank.
Mm-hmm.
No change in the ownership of the bank, of the management team, the people that are working at Fidelity Bank, the markets that we serve. That all still stays the same. It really was a rebranding, renaming
Mhm.
to focus on who we are. and to eliminate the confusion with the multitude of fidelities that are out there in the industry. And it also kind of just gets to our focus on working with our clients in an honest and transparent way to help them achieve their success, whatever that may be. And it really is all focused on those relationships that we get to build and the stability that we have in our client base and in our employee base, because it's only through those relationships that you can really start to work on those projects together and help you go. So from the standpoint of the clients that we work with and the people that do our funding and our warehouse team, they've been with the bank a long time.
Right.
They really get to know Rachel and Kelly and any of the people that are funding loans here at Summit basis. They get to know each other. And so they can have those wonderful relationships.
Yeah. Well, it's, I think the new name, I like the new name. And I think it really is going to give you an opportunity to differentiate yourself and to really bring forward some of the values that the bank has, right? And so I was thinking about this a little bit, and I was thinking about, what kind of qualities do I look at for, a partner, in the business. And so I just wrote down a few different things here. I'd like to just tell you what the list is, and then tell you, I think it's a great branding choice that you've taken to move forward with Scale Bank. So my list here includes stuff like, trust and reliability. So we've talked about that a lot here today. Resilience to adversity, right? We've been through a lot.
Yeah.
So adaptability and growth, right? So we've done a lot of that over the years, right? A long-term vision, right? We just talked about 30 more years here at least, right? And what are we doing to make that happen? Emotional support. Some of these things are up and down in that personal relationship. Just having somebody that is there for you. It's an important part. Mutual growth, right? We just talked about both companies have really grown over the last 30 years. And really, kind of what we're talking about is looking out for each other. And that's through different ways of risk mitigation, right?
Absolutely.
And so we have a lot of conversations of, hey, what are you seeing out there? What are you seeing?
Exactly.
How does this affect you? So, those are all things we're looking for in a great partner. And you guys have done that for us. So.
Thank you.
Yeah.
You've made that statement before, and I so appreciate it because you've said, hey, this is something I'm seeing. I want you to know about it so that you will be here for us.
Exactly.
And I can't thank you enough for that. We do appreciate it. It's been a wonderful relationship. I want to thank you so very much for spending this time today.
Yeah, thank you. Thanks for having me.